The second section of this four-part series, which lasts about 30 minutes, discusses a few introductory things. These include some relevant basic accounting concepts and comments on the nature of the balance sheet of a subsidiary, as well as the need or lack of need for assets, tangible and intangible, to be recorded on the balance sheet. The discussion also asks the question of who cares what the subsidiary's balance sheet looks like.
Colin, do you know what a balance sheet is?
Roughly.
Roughly. Okay, what's a balance sheet?
It's got assets on one side, liabilities on the other. See how much you have or don't have.
Okay, that's pretty good. Assets, assets on one side, and liabilities and capital, or equity, wherever you want to label it, on the other side. And, they have to equal. Okay, well, let's just look at it and think conceptually for a moment about it. We typically, in the bean counting world, think about a balance sheet in using sort of a T where the assets are on one side and the liabilities and now this area down here has different labels. It could be capital, it could be owner's equity, but let's call it capital down here. So there's various labels for it. And the point is that if we add up the amounts, the total at the bottom has to be equal to the total at the bottom on the other side. So one side has to equal the other. Sometimes we, in the accounting world, laughingly say the debits have to equal the credits. All else is commentary. Okay, well, why is this such a major thing to you here when we talk about tax structuring? Because what I want to do is talk a little bit about this area and what I think of as a related area, which is important, especially for your assignment 4. There's, I guess, a name for this, maybe you've heard before, which is double entry bookkeeping. Now, whether you're talking about domestic tax issues in your country, whether you're talking about international tax issues, having a little bit of an understanding of this conceptual thing about a balance sheet is, I think, very helpful, because we can all research the tax law, we can all look into whatever rules or rulings or practices there are in each country, but we have to understand what economically they mean. Just a couple of simple examples here, just to make the point about, for every debit there has to be a credit. For every time you do something on here, at the end of the day, you still have to have identity between these two. The totals have to equal. Okay, if a new company is formed and the owner puts in 100 of cash as in payment for the shares, for the new shares that are issued, then we have cash of 100 and we have capital of 100. Okay, we add up 100, 100, it equals. So without getting into too much detail, there would be an accounting entry to record this. We debit cash, we credit capital. Not too difficult, but Again, both sides so that the total's equal. If let's say 75 of that cash is spent to buy a table, then we will debit an asset account, which is the table, fixed asset, for 75, and we will credit cash. So now, instead of having after that transaction, we now have 25 of cash, and we have fixed assets of 75. Okay, still 100 equals 100. All we've done is affected the asset side of the balance sheet. Well, maybe we need more money in order to start whatever business this is going to be. So we go to a bank and we borrow another 100. Let's say we have a liability to a bank for 100, and we now have 125 of cash instead of just 25. We've debited cash, we credit our liability account. Again, the totals, this adds up to 200 on the asset side, and it adds up to 200 on the liability and equity side. We know that in assignment 4, there's going to be a need for the use of certain fixed assets, machinery, and certain intangible assets by whatever company is formed in order to conduct this manufacturing business in your two chosen countries. Does an asset have to be on the balance sheet in order for it to be available for use by by that company? In other words, if this is the subsidiary, let's say you decided that you need to form a subsidiary in your chosen country to operate the manufacturing business. Does the machinery, for example, I think there was roughly $10 million of machinery. Does it need to be, do those numbers, the $10 million or some other number, does it need to be on here? Well, maybe, maybe not. It depends on how you contractually make that machinery available. Now, I'd like you to keep this little bit of background in mind. I'd like to go through a few slides that we haven't gone through before in the class. And then I'd like to go to the factual situation and talk a little bit more specifically about some of the things that are in the factual background for assignment 4. We've talked a little bit about the nature of the balance sheet. This point here about the combined debt and equity or capital section is very often referred to as the financial structure of a company. How much debt is there? How much equity is there? Getting to the point of talking about the use of the machinery and the intangible assets, the point here that operating personnel know physically what tangible and intangible assets must be available to the subsidiary for it to conduct its intended business. Now again, here we're talking about what's physically needed. We're not talking yet about legally how do we get it there. You are lawyers trying to specialize in taxation. So, of course, you're very interested in how it will legally get there. But, you know, there's a number of ways that the assets can legally be available for use. So you need to have an understanding of, well, gee, what are those mechanisms? And then taking into account the physical needs of the client, the particular legal and tax rules applicable to the country you're in, you can end up with a specific recommendation. Or maybe, you know, two approaches might be very good, and you help the client decide based on the client's objectives which one is best. We have to start out with what's physically necessary. There's not a focus, you know, yet on what are the legal mechanisms, but we need to understand physically what's necessary. In Assignment 4, you know that there's certain machinery that needs to be there available for use. You know that certain intangibles need to be available for the use. So that's the physical part, identifying those things. Important, very important. Whenever we talk about a balance sheet and what's on it, an obvious question is, well, who cares? Who cares what's on the balance sheet? We're talking about a situation where we have, in Assignment 4, ABC, unless local rules require it, the factual situation tells you that unless local rules absolutely require it, ABC wants to own 100% of whatever entity you form to conduct the manufacturing operations. Well, if ABC owns 100%, does ABC itself really care about what's on the balance sheet? I mean, is it ABC likely to have any concern about whether there's a lot of debt or little debt, or I mean, do they care? Economically, does ABC care whether the balance sheet looks one way or another?
It does.
It does. Okay, why?
Because at the end of the day, you also need to see, because when your profit from your profit and loss sheet comes on your balance sheet, right? On the income side, if you have a profit comes on the income side, if it's a loss, it comes on the loss side.
Okay, now remember, okay, you're making a very good point, but we have to think about the, we have to think about who we're, from whose perspective, you know, are we looking? We have ABC, and again, I'm assuming that you have decided that you need a local company to conduct the manufacturing. I mean, you could choose, for example, to have a branch operation conduct the manufacturing. And if you choose that will have certain consequences. But let's assume that you have decided that in your chosen country there needs to be a subsidiary, and let's assume it's 100% owned. Now, ABC will have its own balance sheet, and the subsidiary will have its own balance sheet. So we have two balance sheets. When ABC management is looking at things, yes, they are, of course, concerned about the separate legal entity numbers, but as a practical matter, most of the time, they are looking at this on a company-wide basis or a group-wide basis. The numbers which are reported to the investment community, to the capital markets that buy and sell the shares of A, B, and C, they're looking at consolidated numbers. And the balance sheet of the subsidiary and the balance sheet of the parent are combined. And as a result of that combination and the cancellation, effectively, of any intercompany debt or equity, the management of ABC normally doesn't care what's on the physical balance sheet of the subsidiary. Usually does not. The local management in the subsidiary, they might care if their compensation is partly based on how big and important this company looks. Their own prestige may be higher if the balance sheet has higher numbers on it. But from ABC's perspective, it really, for the most part, makes little difference what numbers there are on that subsidiary balance sheet. If you can provide a structure, for example, that, again, allows the subsidiary the use of those assets, the enough funds for it to conduct its operations, whether those assets are on the balance sheet or not on the balance sheet, how much equity or debt there is at the subsidiary level, ABC generally doesn't care. So that if you find a particular advantage of doing things one way or another, I mean, a very common thing is, gee, it's normally better to have more debt, more interest-bearing debt than capital. Well, gee, why? Well, rightly or wrongly, we have a legal and tax system worldwide that generally says you get a deduction for interest. You do not get a deduction for dividends. So if you have interest-bearing debt, from a tax perspective, normally it is a better tax answer than just dropping in more capital and having more equity on the balance sheet. Now, there are situations where that's not true, but there's very much an incentive for companies around the world to organize their subsidiaries in a fashion where there is shareholder debt to the extent they can have it, instead of more equity capital.
Professor, I just want to understand the background. You're saying that ABC owns a fixed asset and it will transfer the same to the subsidiary for use.
We know that the factual situation is that ABC's non-food division has technology to manufacture a particular food processing product, machinery and equipment. They have patents over it. They have knowledge of how to use it. And physically, we know that it will be produced by the non-food division in the United States, and it will be used in your chosen countries to manufacture cereal and bars. So that's our physical need. Yeah.
So ABC could also be selling that machine to the subsidiary, right? Because as per the transfer pricing.
Well, okay, but you're absolutely right. That's an issue, but let's get to that a little farther down the road. The point is that yes, one method of getting the machine, the use of the machine in the subsidiary, is through a sale. And we'll talk a little more about that as we go forward. But it's sort of we need to do things, I think, in order. We need to understand, okay, physically we need to do something. And what physically we need to do comes out of understanding the factual background of your client or of the company you're working for. In this case, understanding what the facts are for ABC and its goal of producing cereal and snack bars in the country. It needs to have machinery and equipment. It needs to have certain technology. But we haven't gotten yet to, okay, how does it get there? And there are choices in how to get there. And yes, selling it is one question. And the obvious next thing, remember, double entry bookkeeping. Gee, if there's going to be a sale, well, normally that means, have you ever bought something at a store?
Yeah.
Okay, you pay. Okay, you don't just take it and walk away. You paid for it. Okay, double entry bookkeeping. There's two sides. I bought an asset, I paid for it. There's two sides to it. So where's the money come from to pay for it? Does it come from more debt? Does it come from invested capital? Does it come from somewhere else? We need to be thinking, in a sense, not just on, gee, is it a sale, but we need to then go the extra steps of, well, how are they going to pay for it? And that's part of this issue of what does the balance sheet look like? Okay, now, to try to keep in some sense of order about this, okay, I've said that ABC generally does not care what is on the balance sheet, does not care what the numbers are on the balance sheet of the subsidiary, because it all gets consolidated in the sense of financial statements. It doesn't make any operational difference to ABC as long as the use of the equipment is there, as long as the use of the intangible property is there. ABC doesn't care what's on the balance sheet, leaving you free to come up with whatever gives the best answer and accomplishes the objectives of the client in the best fashion. If ABC doesn't care, who does care? I mean, we're talking about this, and the implication of talking about a balance sheet at the subsidiary level implies that somebody cares. Otherwise, I wouldn't be talking about it. So let's go back to our slide. Unrelated creditors. We're talking about a relatively sizable subsidiary that's manufacturing and that's conducting a rather important business and large business. That subsidiary could borrow locally from a local bank. Certainly, if it buys on credit from local vendors, they would care about what the balance sheet looks like. Local tax authorities. Remember, one of our principal topics, again, this term that I like to use is not a term which anybody else outside of this classroom uses, but I can't think of a better term, and that's the sanctity of the legal entity. If you have determined and advised ABC that they should form a subsidiary in your chosen country to operate this business, that is a separate legal person. And your friendly local tax authority looks at that company and cares about what the balance sheet of that company looks like, and the income statement as well. I don't want to suggest that the income statement is not also important. It's just that when we're talking about how do we get the use of the assets into a company, we're normally focusing on the balance sheet. So anyway, local tax authorities, they look at the legal entity that is within their jurisdiction. And it's, in this case, the subsidiary which is being set up to conduct these operations. I mean, why do local tax authorities care?
Yeah, because the tax rate is, if it's uniform on all the taxable income, then why do they care?
I'm not sure there's a real good answer to your question. I think it's just that the environment we're in, you deal, the tax authorities or the local regulatory authorities for permits, business permits or whatever, they deal with the legal person or the human being who is conducting activities. And you're, the client, you're advising the client on what sort of organization to set up and how to conduct business. The regulatory person, whether it's taxes or whether the local officials who help set up companies or they are responding to what you place in front of them. If you decide that a limited liability company, in Japan, let's say a Godo Gaisha, is the right type of organization to form, that's what they deal with. They're not going to look at it and say, well, gee, why didn't you form a Kabushiki Kaisha, which is a different type, or why didn't you, have some other legal form of organization? They're going to look at the legal entity that's there. And, you in advising, you need to be looking at the whole list of, the whole laundry list, so to speak, of possible legal ways of conducting the activities and decide which form makes the most sense that will deal with the various objectives. I mean, just a simple non-tax example. Is limitation of liability important or not? Well, if it's not important, then, in some countries you have forms of organization where, whether it's a partnership or some sort of company which has liability that transfers to the unit holders, you could choose that if it were beneficial for whatever reasons, whether it's tax reasons or other reasons. So usually we find that companies say, yes, they would like, all things being equal, limited liability. So most of the work we do with companies and clients involves entities which do have limited liability for their owners. But it doesn't have to be that way. And in fact, again, just to digress, just a small amount, let's say that you really make a decision that it's better to operate in a particular country in partnership form for some reason, but limited liability is important. Further, a partnership implies two partners. Would we say in this kind of situation where there's just, one company that is, that wants to operate in this other, let's draw it out because it's, I think it's easier that way. Let's say we have a company X, and X, like I say, wants to operate in country B. Now, you've decided that if we can, we want to operate in country B in partnership form. Now, you could achieve your objectives of partnership form and limited liability if you wanted, simply by forming two subsidiaries, and each of those subsidiaries become a partner. Think of your Tokumei Kunii in Japan. some companies are doing it this way because there's a tax advantage in reducing Japanese tax. Then you get to a substance versus form issue, and that's another question. You can achieve the objectives of partnership form in country B and limited liability for X by doing this, if it makes sense to do it. I keep talking about there being a blank sheet of paper. Well, this was a blank sheet of paper before I started drawing on it. And you have the ability to try to structure what makes sense for your client and its situation. Okay, I think I already mentioned that local officers and directors, of course, they might care about the balance sheet, whether for prestige reasons or their local compensation. But again, ABC at the top generally doesn't care what that balance sheet looks like. Construct whatever you want, whatever gives the best answers, we're happy with it, because they're looking at it from above.